$3,200 a month. That's a pretty common mortgage payment here in Southwest Washington. And depending on your financial situation, that number probably makes you cringe a little. Here's what most people don't realize. That $3,200 isn't just one payment going to one place. It's actually 4 different payments bundled together, and understanding what each piece does, where that money actually goes, changes everything about how you think about your mortgage. I'm Dustin Hutley with Envoy Mortgage, and today I'm going to break down exactly where every single dollar of your mortgage payment goes. And by the end of this video, that scary number is going to make a lot more sense, and you're going to know exactly which parts are building your wealth and which parts are just the cost of home ownership. In the mortgage world, we have an acronym. PITI stands for principal, interest, taxes, and insurance. These are the 4 components of virtually every mortgage payment. I'm going to show you what each one means with real numbers. We're going to use that same $3,200 a month payment I mentioned earlier, which is pretty realistic for a $450,000 home with about 10% down at current rates here in Clark County. First up, principal. This is the money that goes toward actually paying off your loan, reducing what you owe. And here's the beautiful thing about principal. Every dollar you pay in principal becomes your equity. Think of it like a forced savings account, except instead of sitting in a bank earning almost nothing, that money is building equity in an appreciating asset. In our $3,200 a month example, roughly $367 goes toward principal each month at the start of your loan. Now here's something cool about principal. It grows over time. Mortgage payments are structured so you pay more interest at the beginning and more principal toward the end. So 5 years from now, that same $3,200 a month payment might have $500 or $600 going to principal, and over 10 years, even more. This is why people say owning builds wealth, because every month a chunk of your payment is literally becoming your money. Next, interest. This is the cost of borrowing money. It's what the lender charges you for letting you use their $400,000 to buy a house you couldn't afford to pay cash for. I'm going to be real with you. Early in your mortgage, this is the biggest piece of your payment. And unlike principal, interest doesn't come back to you. It's the price of admission. In our $3,200 a month example, at current rates around 6.5%, you're looking at roughly $2,194 in interest each month at the start. Now, before you freak out about that number, let me give you some perspective. 1, mortgage interest is typically tax deductible if you itemize, so some of that money comes back to you at tax time. 2, as I mentioned, this number goes down over time while your principal goes up. That's how amortization works. And 3, compare this to rent. If you're paying $3,200 a month in rent right now, 100% of that goes to your landlord's wealth, not yours. At least with interest, you're still building equity alongside it. People get really focused on interest rates, and I get it, but here's the truth. The rate matters less than whether you're building equity or not. A 6.5% rate where you own something beats a 0% rate on rent where you own nothing. Third piece, property taxes. This is the money that goes to your local government to fund schools, roads, fire departments, parks, all the stuff that makes your neighborhood a place worth living. Here in Washington, property tax rates are roughly 1% of your home's value, which is actually a bit below the national average. So on a $450,000 home, you're looking at about $4,500 a year, or roughly $375 a month. Now you might be thinking, wait, I have to pay taxes on top of my mortgage? And technically, yes, but here's how it works. Most mortgage payments include an escrow account. Each month, your lender collects the tax portion along with your mortgage payment, holds it in escrow, and then pays your property taxes for you when they're due. That way, you're not scrambling to come up with a big lump sum twice a year. It's forced budgeting, and honestly, most people prefer it that way because it turns a big annual expense into a manageable monthly one. One thing to know, property taxes can change. If your home value increases, which it probably will over time, your taxes might go up as well. Your lender will adjust your escrow amount annually to account for this. And finally, insurance. This actually has 2 potential parts: homeowner's insurance and possibly mortgage insurance. Homeowner's insurance. Homeowner's insurance protects your property against damage, theft, and liability. This is required by every lender. They want to make sure their investment is protected. In our area, for a $450,000 home, you're typically looking at around $125 per month, depending on coverage levels and the specific property. Mortgage insurance. Now, if you put less than 20% down, you'll also have PMI, private mortgage insurance. This protects the lender if you default. I know it feels unfair that you're paying for their protection, but it's also what allows you to buy with less than 20% down. PMI typically runs between 0.5% and 1% of your loan amount per year. On a $405,000 loan, that's roughly $100 per month. Here's the good news about PMI. It's temporary. Once you reach 20% equity in your home, either through paying down your loan or your home appreciating in value, you can request to have PMI removed. On a conventional loan, it's required to drop off automatically at 22%. 20% equity. So yes, it's an extra cost early on, but it's also what makes home ownership possible for people who haven't saved up a massive down payment. All right, so let's put it all together. Here's our $3,200 payment broken down. Principal, $367. This is building your wealth. Interest, $2,194. Cost of borrowing, partially tax deductible. Property taxes, $375. Keeping your community running. Homeowners insurance, $125. Protecting your investment. PMI, $100. Temporary cost of buying with less than 20% down. Now here's the mindset shift I want you to make. Compare that to renting. If you're paying $3,200 a month in rent, after 10 years, you've paid $264,000 and you own nothing. You've built zero equity, you have zero to show for it except receipts. If you're currently renting and wondering whether you can afford to buy, now you know what that monthly payment actually is. It's not one big scary number going into a black hole. It's 4 specific things, and one of them is building your wealth. If you're already a homeowner, take a look at your statement. If you can identify each piece, know what's going where, and if you've hit 20% equity, check if you're still paying PMI, because you might be able to eliminate that expense. If you'd like to learn more about what you can qualify for, click the link in the description below. I'll run your personalized numbers and show you exactly what your PITI would look like so you can make an informed decision. We'll see you in the next video.